Hello and welcome to class. Today we're going to be talking in financial accounting about the chapter on liabilities. In some books, this covers actually two chapters. For McGraw-Hill, it's like chapters 9 and 10, but the Wiley book, it's just chapter 10. I actually like to talk about both of these chapters together because they both are they're both about liabilities, and it really doesn't need to be separated into two chapters. So we'll discuss them all together. Liabilities has, just like assets do, liabilities have different categories and classifications. We have current liabilities and long-term liabilities. If I'm looking at the balance sheet of a company, I would probably say that their current liabilities are one of the most important things that I want to look at. And the reason for that is that if a company can't keep its lights on, it can't stay in business. If a company can't pay their employees, they don't have employees anymore. If you can't pay your rent, you get the idea. So if we can't make those current payments, taxes, and everything else, we aren't going to last for very long. A lot of other things can be dealt with in business. We can figure out how to become more profitable. We can figure out how to pay off long-term debt, but that's only if we can keep the lights on. And so we want to look at current liabilities, and then we're going to look at long-term liabilities. Long-term liabilities, primarily what we talk about in that section is bonds. Now, bonds are a type of note payable, a long-term note payable. And companies can either get capital, get cash from investors or banks or by earning, right? There's really three different ways we can get cash into our business. I can sell stock, I can issue bonds or take out loans, or I can earn. Well, bonds are a type of borrowing, but bonds are now not borrowing from a bank, but borrowing from investors. You know, the state, for example, of California issues a lot of bonds. The US government issues US Treasury bills, Treasury bonds. It's a different way to get and to raise money. It has to be paid back, whereas stock doesn't have to be paid back. But there's some unique things that come up with bonds, and we'll talk about that in some detail today too. So without any further delay, let's jump on in to the PowerPoint. Hope everybody's doing well, and let's check this out. So here we go. So I may need to update this PowerPoint on some of the websites, but here we're looking at liabilities, short-term and long-term, so I'm combining the two again. Okay, so a current liability, this word current should sound familiar. We had current assets. What I want you to know with current is that it needs to be paid within 1 year or operating cycle, whichever is longer. Okay, well, that was similar to a current asset. It was something to be expected to recover, be able to be recovered or turned into cash within a year, right? A resource that we're going to be using within a year. Current versus current liability, we're going to pay it off within a year. Again, that's a really important thing for me to know about in a company, is to know, okay, you may have tons of liabilities, but if they're not current, they're not maybe as concerning. Now, I know personally, I'm much more concerned about my mortgage payment that's due this month than I am about the entire mortgage that has to be paid off within 30 years. That's a lot of money to deal with if I had to deal with it all right now. But can I handle this month's mortgage payment? Hopefully, probably. And so that's the idea of how current is sometimes more of a focus. So current liabilities, let's not make a list, guys, but there are all sorts of accounts payable. We have unearned revenues, taxes payable. Notes payable can either be long-term or short-term. Notes payable, oftentimes in your homework problems and stuff, they list note payable first in the current liability section. Now, be very careful to see that it's a note payable that's due within 1 year. Because if it's due longer than a year, then that is not a current liability, it's a long-term liability. Now, even with a long-term liability, think about what I just said with the mortgage. If I have a 30-year mortgage, Well, part of that is due over 30 years, right? That's a long-term liability. But there's a part, my next 12 months of mortgage payments that are due this year. Isn't that current? That's what I should be probably most concerned about, at least to start. And so even a note payable can be broken into long-term and short-term. So you're going to see notes payable under both, okay, current or long-term. A note is a written out instrument. It's like when you go in to buy a car. Unless you're throwing down cash for the whole thing, you're going to sign an agreement. You're going to sign an agreement that says you're going to pay back this loan within some amount of time, with some amount of interest rate. You're signing a note. You buy a house, you're signing a note. Okay, that note is a written out contractual agreement that you're going to pay back a certain amount of money over a certain amount of time. It's like an account payable, but just typically longer term, typically with an interest rate. It doesn't have to be long term, but so here we have on September 1st, this company signs a $100,000 12% note, 4-month note, maturing January 1st. Okay, so there's going to be 3 different journal entries we're going to look at. So I need you to pay close attention. This is journal entry number 1. Journal entry number 1 is when a note is issued. Okay, that's important. When a note is issued, let's see, what does this say? Okay, so we're just borrowing. We're going to the bank and we're borrowing money. So what are we getting? We're getting cash and we're signing a note, signing a contract saying that we're going to pay back. So I'm going to debit cash, credit note payable. My cash is going up, my assets are increasing because I'm getting cash from the bank, and my notes payable also going up. That's when the note is issued. Next, I'm going to make a journal entry to record interest. Now let's look back at this. Remember, September 1st. So on September 1st, I'm borrowing the money at September, October, November, December, but I'm not paying it back until January 1st. So on December 31st, what do I have to do? Remember, because of the revenue recognition principle, it says that I have to make an adjusting entry to record interest on my financial statement date. Okay, so in this case, I'm not paying the note back, but now I owe some interest. I owe 4 months of interest. Do you remember that interest calculation? Same thing as note receivable. I take the amount, I didn't mean to push that. Okay, so I take the amount, 100,000, times the interest rate, the annual rate, times time in terms of 1 year. Remember, this is 4 over 12 to get interest of 4,000. Now remember, I'm not paying this. I'm paying it tomorrow. But the revenue recognition, I'm sorry, let's not say the revenue recognition principle. Let's say the matching principle. But it's because of accrual accounting, right? The matching principle says that I have to record expenses when they're incurred. Now the bank is recording revenue. The bank is recording interest revenue. So anyway, sorry, it's the matching principle. So, but both because of accrual accounting, I have to accrue this interest, and it's due. It's a payable. Okay, accrual accounting says I record things when they happen, not when they're paid, but when they happen. I had this money for the last 4 months. I have to show that I owe interest for those 4 months. And that interest is related to these last 4 months, not when I pay it. Because when I pay it, if I recorded all the interest when I paid it, I'd be recording that interest expense for the wrong year. I want to record the interest expense now. And then when I pay the note, now I'm paying the note plus the interest. Okay, so the note payable. So if I had, some T accounts here, I would have a note payable account. I owed $100,000 in that account. I need to debit $100,000 to make that balance zero. Same thing with interest. I have to debit the interest to bring that account down to zero. Now the cash that I'm paying is the principal, the 100, and the interest. I'm paying a total of $104,000, which is the principal and the interest. The principal being the face amount. Okay, makes sense? Sure it does. Sorry about that matching principal thing. I'd written the revenue recognition principle, but we're talking about expenses, so it's the matching principle. Okay, now one thing might come up in that, and we'll go over this when we talk in class, but if I have a note that, like, let's say it started in September and I make a journal entry, I make my journal entries, I'm making my financial statements rather at the end of September. If I borrow money on September 1st, but I make my financial statements at the end of September, then I would accrue 1 month of interest. And then if I still paid it, then I would have to record some additional interest. Okay, so let's just watch out for that, I guess. And actually, let me go over an example like that with you, just for fun, because this is something that will come up on your exam, and I want to make sure you know how to deal with it. Okay. So let's say I had that same note, 100,000 $12% 4-month note. But now I'm preparing financial statements on September. The end of September. Okay, so what we're going to do then is to record the fact that we have interest. If I'm borrowing the money at the first of the month, so I'm borrowing it on September 1st, signed September 1st, financial statements prepared on September 30th, and paying off note on January 1st still. Okay, so let's issue the note. So that note, the first entry is the same as what we had on our slide. So I'm showing that I'm getting cash and I have a note payable. Okay, that doesn't change. Now the second entry is going to be to accrue the interest. Now, if I'm looking at this, I'm going to say, okay, it's a 4-month note, 12%. But on September 30th, I'm making my financial statements. So to accrue that interest, I'm going to take the face amount times the rate times, I guess, 1/12. So it's 1 month. Okay, and that's going to give me $1,000. Okay, so just the same entry as the other one is to say that I have interest expense for that 1 month. Remember, the matching principle says I have to record this in the proper period. And so in order to do that for my September statements, I want to show that interest expense for September. And of 1,000. Okay, so that's the accrual of the interest for the 1 month. Now I'm paying the thing off in January. So really, I should be accruing interest every month, but let's say I didn't accrue any more interest. I just waited because I did my financial statements and I don't regularly accrue the interest, but now I'm paying it off. Okay, so now I'm paying off the note. Now, my note payable is being paid off for $100,000. And remember, I have a note payable account. When I started, when the note was issued, I had a credit balance. I want to debit that account now, so I can have a zero balance in that account. Okay, I now have this interest payable account too. And I had $1,000 in there. Well, I want to pay that off now. But now I have some additional interest expense, don't I? Okay, so, well, this tells me I'm going to debit interest payable for 1,000. But now I have, I guess, what, 3 more months of interest expense? Because I still have that money for 3 more months after I accrued this the first time. We did the same thing for notes receivable. Okay, so now I've got another 3 over 12 equals 3,000. So interest expense is another 3,000. And now I'm paying out the total cash of 104. I feel like I've said interest revenue a few times in place of interest expense. I don't know why I'm having some sort of a connection meltdown as I'm talking. I feel like I'm saying the wrong word. So anyway, it's interest expense, right? I have additional interest expense and calculated by that. Okay, I recorded the first amount of interest expense at the end of September. I'm paying that off and paying the note off, and I'm paying all the cash out. Okay, we did something very, very similar when we talked about notes receivable. And we were recording interest revenue at that time, but it's the same idea. Okay, all right, sales tax payable now. Sales tax payable is, if you think about who sales tax is a tax on, sales tax is a tax on the buyer, right, on the consumer. When you go into a store and you buy something for $100, they're going to charge you $107 or $108 based on whatever county or state or whatever you're in for sales tax. Okay, so if you think about that, the company's collecting this money. They're collecting the money from you, but it's not their money. Part of it is because they're making a sale, but there's another part that's sales tax. And so that's not their money. To them, that's a payable. So if I look at this, then I say, okay, company's making sales of $10,000 and collecting sales taxes. Okay, so what's the company getting? We're getting cash. We're getting cash. We're collecting, what, $10,600 in cash? Now, a part of that is revenue, but the other part is the sales tax that I've collected. Now, sales tax is collected from the consumer, but it's only that the state requires that stores collect this. It used to be that not all companies had to collect sales tax. For example, Amazon for a long time didn't have to collect sales tax. And brick and mortar normal stores hated that because people would go online and buy stuff and not pay any sales taxes. So, you saved a lot of money by buying things online. Now, you didn't really save because you really technically still owed the tax. It's just that Amazon didn't collect it. And so it was up to you, your responsibility, to write a check to the state for that sales tax. Now, I don't know if a lot of you did that, right? The state has learned that they cannot trust you because if you buy something and the store does not have to collect sales tax, you're simply not going to pay it. It's like a discount to you, right? But a lot of people didn't even really realize. They just thought, oh, they're not charging sales tax. That's great. Well, the sales tax is on you. It's not on the store. So if they're not collecting it, you still owe it. And in fact, on your state tax return, on your California state tax return, they actually have a line there available for you to tell them what amount you bought, but we're not charged sales tax on, and then you can write a check to the government. So if you feel like it, if you feel like you haven't paid enough, haven't paid your fair share yet, you go ahead and get your checkbook out and write a check to the government for all the things that you've bought in the past and did not pay sales tax. So here's one thing we need to know how to do. Okay, so in this example, we're saying, and there's going to be a problem like this on your exam, where it says that we have total receipts of 10,600, but it's not breaking out for us what amount of that is sales versus sales taxes. It's just saying we collected a total of 10,600. Now, we know what the answer is already because we just did this, we just used these same numbers. But if we're given a total amount like this, 10,600, then if you look down here, what you have to do is take the total receipts divided by 1 plus the tax rate. And that's going to give us our amount of revenue. So if you look at this, I'm calculating 10,000. Well, that's the amount that goes into revenue. The rest of it is sales taxes that were collected. So be careful, because a lot of people want to do this. They want to take, oh, it's 10,600. So let's multiply it by 6%, and that gives us our sales taxes. No, that gives you sales taxes on 10,600. So don't do that. Yeah, it's a common mistake, but just understand that I want to back out how much of that was the actual sales versus what was the sales taxes. The 10,600 is 100% of the sales plus 6% sales tax. That's sort of the reason behind that. Okay. So we've talked about unearned revenue before, so we'll just skip past that. It's amounts that are received before work is done. So remember, that's a liability. It's a liability because I got your money and I haven't done anything for it yet. I owe you either the work or your money back. Airlines, hotels, they're always selling tickets way out in advance. They haven't done the work yet, but they have all the money. Okay, so lots of companies have to deal with unearned revenue. I'm going to skip past this. We already did this before, the adjusting entry for unearned revenue. If you don't remember that, just remember we're collecting 500,000 up front, and then as we earn, or as the games are completed, that's earning, right? When we complete the games. As we complete the games, we're going to show the revenue being earned and the liability going down. So liability is going down here, revenue is going up. This is something from one of the earlier chapters, adjusting entries. Okay, I mentioned current maturity of long-term debt. Okay, so if I have, and this is where I have a mortgage, right? I've got a mortgage and a part of it's due over the next 30 years, a part of it's due this year. So in this case, they're seeing $25,000 note, and there's a certain amount of it that's due right now or this year. Okay, so part of it's going to be classed as long-term, a part as short-term. And that's important because if I look at any business or person and I see that they've got millions of dollars of debt, that might be concerning, but I'm not as concerned. Like if I look at somebody that has a $1 million mortgage, that's a lot of money. Yeah, if you had to pay it today, that's a lot of money. But if you can pay it over the next 30 years, well, it's still a lot of money, but it's way more manageable. Okay, so you've got to understand that we want to break that out so we really understand, because if you have $1 million of current liabilities, you're in trouble unless you just got $1 million around, and most people don't. Okay, another type of current liability would be related to payroll. Okay, I want to go over this with you a little bit. So we have wages or salaries, whatever, that's fine. Gross earnings, gross is total. The net amount is the paycheck. That's how much that employees are actually going to be getting. And then we have a bunch of payroll deductions. Now, you tell your employer what you want them to withhold from your paycheck. Now, you don't want them to withhold anything. You want the whole paycheck, but you owe taxes. And so on your behalf, your employer will hold those taxes for you and send them into the government. But you actually tell them, if you didn't know that, you actually tell them how much to withhold. Now, some of it they actually just take, like there's one amount that they actually just take out of your paycheck. The other amount is something you tell them. On your W-4, you tell them how much federal tax to withhold, if any. Okay, so this looks like a crazy journal entry. It's just because there's a bunch of accounts, but if you look at this, I have this company that has contracted to pay their employees $100,000. Now the employees aren't getting $100,000. They're getting 67. This is the net. This is the gross. This is going to be the actual amount that's going to be paid to the employees. This is cash to the employees, going out to the employees. The rest of these amounts are amounts that are being withheld from your paycheck. Again, on your W-4, you tell them how much to withhold for state and federal taxes. They'll have a state equivalent of a W-4. And you fill out some, they have this worksheet thing you fill out, nobody understands it, and you end up just putting down that you have one exemption or two or whatever, and then they withhold some money. You don't know how that works. You can actually figure that out before you go in and fill out your W-2. ADP, so ADP actually has some calculators that you can use. If you end up getting like a big refund or whatever, if you end up owing taxes, you can actually figure out how much you should have withheld so that you'll be fine at the end of the year. Okay, but you tell them how much to withhold. I actually tell my employers that I have 99 exemptions. And now I know what you're thinking. You're thinking, this guy's committing fraud, and he just admitted it. No, it's okay. When I say 99 exemptions, what I'm telling my employers is that I don't want them to withhold anything. Okay, the reason I might do that is because I have self-employment income that comes in on the side, and I want to, and I can figure out how much my tax liability is going to be, and I will write a check and pay it myself. You can either have employers withhold taxes or you can pay it in quarterly. Either way, you have to pay it. You don't get out of paying it if it's not withheld from your paycheck, but you get larger paychecks, but then you just have to make sure that you put the money aside for taxes. Okay, FICA. Think for a moment and think if you know what FICA is. And if you don't, you should feel ashamed, because this is money that's taken out of your paycheck every single time. And it's not a small amount. So that's why you should know what it is. Same with federal and state taxes. Guys, you're responsible for understanding how much money is taken out of your paycheck. That's important for you to know, just for one, so you know what it all is. But for two, there's a lot of things that come up as you start voting and stuff. We just had an election. Well, as you start voting and you start voting for different politicians, you start voting for different propositions and stuff that are on the ballot. You need to understand that, if we're set to be borrowing a bunch of money for bonds for some projects or something that we want to work on, you have to understand that this isn't free money. You're going to have to pay taxes for it. And the more things like that we do, the higher your taxes have to be to cover all of it. And so, it's good to start paying attention to what these things are and how much you're actually paying. Because FICA, you should know, is Social Security and Medicare. Now, Social Security and Medicare total up to be 7.65% of your pay. That's actually more than that. I'll talk to you about that in a second, but that's if you make $100,000, that's $7,650 just for Social Security and Medicare. That's 6.2% Social Security and 1.45% Medicare. That's a lot of money. Now, you may love Social Security. You might think it's a great program, a great idea, and that's fine, but you should at least know how much it is. It's a lot. Okay, so that's that. This is the amount that the employees are actually getting for their paychecks, but the employer is not done there. This is what you see. This is what you see on your pay stub. Now, in addition to that, you might have retirement being taken out. You might have medical insurance premiums being taken out. You might have union dues taken out. I mean, there's all sorts of things taken out of your paycheck. Now, past that, we have one more journal entry. So I refer to this actually as the employee entry because, and it's not an entry made by the employee, it's an entry made for the employee's paycheck. So this is known, or I refer to as the employee entry. And then I have the employer entry. This is the additional taxes that you don't even know about. You don't know that your employer on your behalf is paying in even more money for you. Did you know that Social Security and Medicare is actually 15.3%? Okay, you pay half of it and your employer pays half of it. Your employer is going to pay an extra 7.65% of your income into Social Security. They also pay into the unemployment. So unemployment is something that the employer pays. It is not taken out of your paycheck, but it's there. Especially a lot of people are having to take advantage of unemployment now with the world falling apart. So 15.3 though. Now, guess what? If any of you are self-employed, you need to know, or if you want to be self-employed, you need to know that if you are your own employer, guess who gets to pay the employer half of Social Security? Well, that would be you. Okay, so now if you make $100,000, you have to realize that $15,300 of that is going to go straight to Social Security. And then you pay federal taxes, and then you pay state taxes, and then you pay gas taxes, and then you pay sales taxes, and then you, oh my gosh, it doesn't stop, right? It's a lot. So just understand, and let's stay out of the politics and stuff of taxes. Just understand, I mean, and everybody can probably agree, it's a lot. I mean, even if you think you should be paying more or whatever, that's fine, but it's a lot. 15,300 out of 100,000 just for Social Security is a lot of money. So, but if you have the joy of being self-employed, just be prepared, because this is coming. Okay. All right. So this is the additional payroll tax, additional employer entry. These are additional taxes that they're paying that you don't even see. You don't see these amounts. They pay into Social Security for you. The other half, they pay into unemployment taxes for you. So you need to understand that if you're making $100,000 from your employer, you're actually making more like 114,000 or something after you start talking about unemployment and Social Security and stuff. And don't even, I mean, that's not even to mention also, medical insurance and everything else that they're having to do. So it's expensive to have employees. And understand when you're asking for a raise and stuff, it's not just the amount that you see on your paycheck, it's other things that they're paying into also. It's just important to be aware. Okay, here's this is just giving you some information. Guys, this is information that's a couple years old. So these amounts change year to year. So I am absolutely not testing you on these amounts. Now it is 6.2% and 1.45%. That's in general true as you go forward, but with some exceptions. But that these limit amounts. So you don't pay Social Security on all your income. You pay it just on the first bits. Now, Social Security affects you and I a heck of a lot more than it affects people that are making, millions of dollars a year, because they stop paying Social Security after a certain dollar amount. Well, for you and I, this might be all we make, or maybe we make a little bit more than that or whatever. So as a percentage of our income, Social Security is actually a lot higher for us than it is for people that are making a ton of money. But look, when you start collecting Social Security, look how happy you can be. This guy has enough Social Security to afford one single rose for his wife. So sweet. Can't get the dozen, but you can get one. Now, hold on. When was Social Security started? Just a little fun fact for you. And what does FICA mean? Okay, FICA stands for the Federal Insurance Contribution Act. Okay, it was started back before World War II by President Roosevelt, and it was an attempt to try to have a safety net for people as you get older and you're trying to retire, to have something to be able to fall back on, and it was very, very much needed at that time, because we had people standing in lines to get the soup kitchen lines, and the people losing jobs all over the place, and very needed. We need something like that now. Social Security has its fair share of problems, but it's a complicated issue. But it was started back in I think it was 1938 or something like that, as we were coming out of the Depression. So. Okay, and this is some information, some specifics about FUTA and SUTA, federal and state unemployment. Remember, this is super old information. Don't worry about these amounts, okay? But you pay federal and then you pay state, so you actually, whatever. Don't worry about that. If you're interested, you can read these. I am not testing you on any specifics about that. Okay, so employer payroll taxes do not include what? Well, that additional, this was the second entry, the additional payroll tax entry was FICA, and it was unemployment, wasn't it? Now, for the employee entry, that first entry, there are federal income taxes. Now, this is for payroll. This is for the employee's payroll. The company definitely pays federal taxes, federal income taxes, but we're talking about, this is withholdings. This is from your paycheck. The company's going to file its own tax return and owe its own taxes. That's not, and doesn't have anything to do with this. This is talking about the entries for payroll. Okay, and now we get to bonds. Let me see. Okay, so bonds are a form of interest-bearing notes payable. Now, if you think about it, like I said, companies have three main ways to get capital. They can borrow, they can sell stock, they can earn. Okay, if you think about governmental agencies, the U.S. government, state governments, county governments, and stuff like that, can they sell stock? If only, right? If only they sold stock, I would buy all of it and I would run things my way. But no, they do not. They do not sell stock. You can't own it. That's why you see all the time when you're voting, you see propositions and things on the ballot where the state's asking for permission to borrow more money. And a lot of it's necessary, right? We need to build roads, we need to do those types of things, but then a lot of it goes to things like high-speed rail. We're trying to build a bullet train to Bakersfield. Is that what it was? I don't know what they're doing now, but it's a tremendous amount of money that we're borrowing to build this train. And I'm not sure, to some of the current circumstances, if that's where a ton of money should be focused on. But then again, maybe it is. I don't know. That's where the voters decide. Okay, but it's expensive, but governments have to borrow the money to do that. Okay, so they sell bonds. So selling a bond, that's a kind of a weird term, but when we sell a bond, we're borrowing money. I'm selling you basically a piece of paper that says I'm going to pay you back with interest over time. That's selling a bond or issuing a bond. Issuing or selling a bond. Borrowing money. Now, instead of borrowing from the bank, we're borrowing from investors. Okay. So don't worry so much about this, but if I have a secured bond, secured means that there's some sort of collateral. I need spell check. Collateral. There's some sort of asset that's backing it up. If I borrow money from a bank, my house is maybe backing that up. If I don't make my payments, they will take my house. But if I don't make a payment for my business, they might take my inventory or my building or whatever. I have some that are unsecured. Now, which do you think is going to pay a higher amount of interest? If I'm borrowing money and I have a secured asset behind it, is that as risky for you to invest or buy my bond, to lend me money? Is it as risky if I have an asset backing it up? No, it's not. And so the bond would pay a lower amount of interest. Remember, there's a risk-reward relationship, and if I don't have anything securing that bond, and if I go bad on it, you just lose out on everything. That's riskier. There's unsecured bonds, which are riskier. There's convertible bonds, meaning that they can be converted into certain numbers of shares of stock. Okay, different types of bonds, but bonds are notes payable. Notes payable. Okay, when I'm looking at issuing or selling bonds, there's going to be a face value or the principal amount. The principal amount, the amount that's due at maturity when the note is over, when it's done. Maturity date is when it ends. I'm going to have a contractual interest rate. This is the rate. Contractual interest rate is the rate that is determining cash payments. It's the rate that I use to determine cash payments on interest. Oh, I guess it already says like cash paid. Okay, so the contractual interest rate, whatever the rate is that I have on my bond, is how much interest I'm going to pay you. Now, bonds are investments just like anything else. Bonds have risk. Can bonds go bad? Can people default on bonds? Companies default on bonds? Well, absolutely. Company goes out of business and you have a bond, you got nothing. How about a government bond? Well, the United States Treasury bonds are what I think it's the 10-year Treasury is considered to be the risk-free rate, meaning that there's essentially no risk when you buy a US Treasury bond. And I guess that's true because even if the economy falls apart and interest rates go crazy and everything else, the government can just print more money, can't they? Now, I know there's all sorts of problems that happen when a government does that, but they can do it. They can pay it back. That might be bad to do that, but they can do it. How about like Orange County, California? Can Orange County, California go bankrupt? Are those risky bonds? Well, talk to people in the 1980s. I can't remember what year it was that the county of Orange, think of all the money that we have in Orange County. It's a pretty wealthy area in general. And Orange County actually went bankrupt. So bondholders may have lost out on all or some of their investment that they put into these bonds. So there is risk associated with it. Like I said, the Treasury bonds, it's set as risk-free, but I guess that's because the government, like I said, can print however much money they need to, with whatever, devastating effects that would have, but they can pay you back, just no promises on what state of the economy afterwards. But so bonds can be issued. So this is important right here. Remember, when I say something's important, just understand it's important. Bonds can be issued at their face value, below face value, at a discount, or above face value at a premium. Okay, I'm about to write down a couple of important things. I just want to define them right now. Okay, when we say the word discount, as it relates to bonds, now there's other discounts that we've talked about, but the discounts for bonds. A discount is a contra liability account. We're actually going to have an account called discount on bonds. It's a contra liability. Now we had sales discounts and stuff. That was a contra revenue. This is a bond discount account. It's a contra liability. It's an additional cost of borrowing. Additional cost of borrowing. It's essentially meaning that we're now not just paying the interest that we're paying semi-annually or annually or whatever. Now we're paying the interest, and then we're going to pay some additional amounts. And I'll show you how that works in a few minutes. It's an additional cost. It's a contra liability. Okay. A premium is called an adjunct account. Now, that's the first time we've seen that. It's the opposite of contra. It's an adjunct account. So that means it's added to. It's added to. Instead of subtracted, contra accounts are always subtracted, right? Adjunct accounts are added to. And it's going to be a reduction in the cost. A reduction in the cost of borrowing. Okay, got to have these words down and understand those things, okay? Okay. So let's look at this. If I have a bond contractual rate, remember, this is, I'm paying 10%. This is cash payments made at 10%. So I'm paying, I have investors that are buying my bond, I'm going to pay them 10%. So if I had like, if I had $10,000 of bonds times 10%, I'm going to be paying them $1,000, let's say, per year or whatever. That's the cash payment I'm going to be making to my investors. But let's say that the market rate. Now, what is the market rate? The market rate is what investors demand. So the market rate is the rate investors demand. So when we say like what the market is or what the market demands or whatever, there's, you know, it's supply and demand, it's risk to reward, it's all that stuff. It's with all of those conditions in place, like what do investors, what are they willing to invest in? Well, under certain circumstances, you're not going to buy certain investments if they're not paying you back a certain amount. Like think about the equity markets, the stock markets in the last few years. People have been making a ton of money. Now, I know it's been super volatile and it's been a mess last year. But before that, would you want to have your money in a bank earning less than 1% interest at a bank? Or would you have rather been in the stock market making 30% over the last few years, I'm saying? Now, historically, the stock market doesn't make that much, but it sure did since Trump got into office, right? I mean, it went from when he was elected to when the virus started. It was crazy how much the stock market went up. So if you were not in the market, you really regretted it. Now, the market completely fell apart and it's still a mess. So who knows what's going to happen. But it's, you know, you wouldn't want your money in a bank earning nothing. You would rather have it be in the stock market. But there's other times where the stock market's a mess. Like right now, you might be like, you know what, I'll take a little bit of less gain on my account because I'm scared of the market. I've been scared of the market for a long time. I didn't understand why it went up so much when Trump was elected, and the market has been sort of going against normal trends over the last number of years. And so it's just been really sketchy, you know? And so sometimes people just, because they can't handle that stress of like, what's the market going to do? They stay out of the market. But then a lot of times you end up kicking yourself because you lose out on a lot of gains. So anyway, that's a whole nother story. But the market rate is what investors are demanding. Okay, so here we have then, if the market is demanding 8%, investors out there are looking for a rate of at least 8%. And when I say that, let's consider that we are Toyota or something. I'm just making this up, okay? I'm Toyota Motor Company. But the rest of the auto industry, companies that are the same as me, Honda and, let's just say Honda. Honda's the same as Toyota, right? I mean, they make different vehicles, but they're essentially the same. They're both foreign auto manufacturers. They make, there's the Camry, there's the Accord, there's the Corolla, there's the Civic or whatever. They're same types of things. They're both very solid, stable, good companies, right? If Honda is paying 8%, but I'm paying 10%, do investors want to buy my bond or Honda's bond? The market's bond, like the other automakers' bonds. Well, they want to buy mine, don't they? Because from me, they're going to make $1,000. How much are they going to make at 8%? They're only going to make 800, right? Well, so clearly I'd rather have the higher payment. Okay. So if I'm paying more than the market, well, then I can charge you more for my bond. Now, guys, brace yourselves, because this, if you're not confused yet, this gets confusing to people. Honestly, it's not that difficult, like once you wrap your head around it, but I know that it sounds very strange when I'm first saying it now. So just maybe listen to this again, take your time. It's a weird concept, but once you get it, it's not that bad. I know that's easy for me to say. But everybody wants my bond. So what I can do is I can say, okay, you want my bond. Here's the deal. I'm going to charge you more money. I'm going to charge a premium. Because you want my bond. If I'm Toyota, I'm in a good position because you want my bond. I can charge you more money, just like anything else, right? You want what somebody has and you're willing to pay them more money for it. If my rate is the same as the market, I'm going to sell it at face value. If my rate is lower than the market, does anybody want to buy my 10% bond if you could buy a bond that's paying 12% with the same level of risk? Now, that's important. Because if I look at Toyota and Honda, do they have the same level of risk? Let's just, for sake of argument, say, yes, they have the same level of risk. They're both, like I said, good, solid, stable companies. There's really not much difference between the two of them. Now, if you looked at their financials, you might find that one is way bigger and way more stable than the other one. I doubt that there's much of a difference, but I haven't looked at their financials, so I have no idea. But, I would obviously want, and remember, as the investor, this would be the payment to you. To us, these payments are expenses, but, the investors want a higher amount of interest, don't they? So if the market is paying 12, they can go out and get a Honda bond at 12%, and I'm only paying 10. Does anybody want mine? Nope. I'm going to have to lower my prices to attract people. Now, remember, I want to borrow money, so I need you to buy my bond. I need you to lend me money because I need to invest in some capital project or something. I need to buy a new machine, or I need to whatever. I need to do something. I need money. I need you to buy my bond so that I have the money. Well, if I still need to borrow the money and I'm only paying 10%, but somebody else is paying 12, I've got to attract you with a discount. Okay, so I don't know how confusing that is. Okay, I think I have too much written on here. That might get a little, I can't erase any of this though, sorry. trying to push the button and it's not letting me do that. So let's look at some examples. Well, okay, first off, let's look at this. What is the rate that investors demand? It's not the contractual rate. The contractual rate is what I'm paying on my bond. It's not the face value rate. That sounds the same as the contractual rate, doesn't it? The stated rate also sounds the same. Those are sort of all the same. It's the market rate. Okay, look at some journal entries here. Now, it starts this discussion with putting things in a little bit of a different term. So here I have issuing, remember, that's selling, borrowing. When I'm talking about issuing, I'm talking about selling a bond, selling you a piece of paper and having you give me money. I'm borrowing your money. So issuing or selling bonds, 100, 5-year, 10%, $1,000 bonds. Oops. Okay. Now, what they say here is that we're selling the bonds at 100. Now, whatever number they say, at 100, at 98, at 102, that is the percentage of face value. So I'm selling $100,000 of bonds for $100,000. What can you tell me about the interest rate for this bond? Well, let's check it out. And this is a big mess. But if my rate, my 10%, is the same as the market rate, then I'm going to sell it at 100 at face value. That's what I'm doing here. I'm selling it at face value. What does that mean about my interest rate? My interest rate of 10% is the same as the market interest rate, isn't it? They sell it at face value. There is no discount. There is no premium. I'm getting cash and I owe the money. This is a long-term 5-year bond. Now, I'm going to be paying interest. I'm going to be paying interest every year or every 6 months or whatever. Okay, I guess this is 10% for the year. When I get to December 31st, I have to accrue the interest. Okay, just like we did with the other note payable at the beginning of the chapter, we have to accrue the interest because of the matching principle. Matching principle says I'm going to accrue interest when I'm making my financial statements. Now, it looks like I'm going to make this payment because I'm not making a payment yet, but let's say I'm making the payment, I'm going to make an annual payment, so I'm going to make it tomorrow. But for this year, I have to accrue that interest. I have to record that interest for this year. Hold on one second. I'm all of a sudden afraid because I feel like I didn't, I thought that I might not have been sharing my screen, but I am. That's happened before. I've talked for like almost 2 hours doing a lecture and realized then that I did not record, and then I have to do it all over again. Okay. Okay, so I'm recording the interest and the interest payable. I owe the interest, and then I would make my payment of the interest. Okay, so same thing. There's 3 entries, right? There's the issuance. This is entry 1. This is entry 2 of accruing the interest, and then this is payment, paying of the interest. Now, I'm not paying the note or the bond off right now. I'm going to pay that off in 5 years. But on January 1st of the first year, I have to pay the interest. So this is a good question. If bonds are issued at a premium, what does that mean? Okay, so that one slide that we have is really important. So let's go back to this slide. If bonds are issued at a premium, what does that mean? That means that my rate must be higher than the market. right? My rate must be higher than the market. Everybody wants my bond. They're willing to pay me more money for it because they're going to get a higher interest payment from me than they are from anybody else. If my rate is higher, I'm paying them $1,000 a year. If they buy this one, they're only going to get $800 a year. So they might be willing to pay me more money for the fact that they're going to get a higher interest payment. Let me fast forward back through this. Okay. So the contractual rate exceeds the market, doesn't it? That's what we just saw on that slide. The market rate exceeds the contractual rate? No, that would be a discount, wouldn't it? The contractual rate and the market rate are the same? No, that would be at face value. So guys, remember, please remember when you're looking at tests, studying for tests, it's almost as important to understand why these other entries or these other answers are wrong as it is to know why A is correct. Okay, so understanding what a premium is. No relationship, well, no, it's not true. Okay, so let's look at this. If I'm selling the same $100,000 of bonds, 10% at 98, that's 98% of the face value. Okay. So I'm selling, so let's think about this for a second. I'm selling $100,000 of bonds. How much do I, if I'm selling them to you, how much do I owe you when this is over? Well, I owe you all the interest payments, but I also owe you $100,000 at the end, don't I? The note, the bond says $100,000. I owe you $100,000 at the end. But how much cash are you paying me? Well, it looks like you're only paying me 98% of the $100,000. I'm getting cash of 98,000. But how much do I owe you again? I owe you 100,000. I owe you 100. So not only am I going to be paying you $100,000 a year times 10%, $1,000 of interest. I'm sorry, $10,000 of interest. I was still on that other example I was doing. 10,000 of interest. I also have to pay you an additional $2,000 when this is over. You gave me 98, but I have to give you 100. Isn't that 2,000 extra dollars I have to pay you? If I'm paying you 2,000 extra dollars, well, that sounds to me like that's an additional cost of borrowing, isn't it? So that's an additional cost of borrowing. It's a contra account. It's an additional cost of borrowing. I have to pay you 2,000 extra dollars out of my pocket when it comes time to pay this off. And I'm paying you $10,000 a year for 5 years. So if I look at this, two things. For one, here's the discount. It's a contra account. It's lowering this balance down. This here is called the carrying value of the note. Now, what we're going to do, now think about this for a moment. Let me see what it says on the next slide. I'll say this in a second. Okay. So it's lowering down the carrying value of the bond. It's considered to be an increase in the cost, okay? Because we're required to pay it at maturity. So if I look at this, I'm paying $50,000 of total interest, 100,000 times 10, and I'm doing that for 5 years. I'm doing that 5 times for 5 years. And I have this additional discount I'm going to end up paying $52,000. So think about this for a second. I'm borrowing $100,000 and I'm paying $52,000 to borrow $100,000. Isn't that expensive? So this is why I say, and regardless of like what, if you think something's super important that we should be borrowing money for it, that's fine. Like when it comes to voting for propositions and stuff, but just understand it, like understand what it is and make sure it's worth it. And if you think it is, then cool, vote for it. That's great. But understand that borrowing money is really expensive. When you're looking at that big screen TV and you don't have any cash, but you've got a credit card in your hand, yeah, maybe think again, because you're paying 20-something% on your credit card interest. If you can't pay it off, if you can't buy it in cash, probably don't buy it, right? But sometimes we do have to borrow, absolutely. And governments especially, they have to borrow. If they're not getting tax revenue, from taxpayers, then they have to get additional cash somewhere else and have to borrow it, okay? So the total cost of borrowing then again is $52,000, okay. Okay, discount on bonds payable. Well, discount is a contra account. Yeah, we know that. Does it have a credit balance? No, it actually has a debit balance. As a contra or opposite of a liability, liabilities increase with credits, so a contra would be a debit, right? So again, guys, know why the wrong answers are wrong. Added to bonds payable? Nope, it's subtracted. A premium is added. Increases over the term of the bonds. Okay, so let's talk about this for a minute. This discount, so I had $100,000 minus 2 gives me a face value of $98,000. Over time, what's going to happen is I'm going to decrease every year. I'm going to do what we call amortize this discount. Now, I'm not going to test you on that. I don't need you to know that in much detail, but we are going to amortize the discount. Amortization, if you remember from the fixed asset chapter, amortization was sort of like depreciation. I'm going to take this $2,000 and divide it by 5. So that means I'm going to amortize it by $400. After the first year, I'm just going to show you what this looks like, okay? And at the end, okay, after the first year, what's going to happen is I'm still going to have $100,000 of bonds. So bond, discount, and then carrying value, CV, carrying value. So I would have 100,000, and then I would have 1,600 left in my discount after I amortize it. Now, this becomes, when I amortize it, instead of debiting depreciation expense like we would do for depreciation or amortization expense, it essentially becomes additional interest expense. Okay, this becomes additional interest expense, but I'm going to spread it out over 5 years. Think of the matching principle and all of that. I'm going to spread it out over 5 years. And so each year, I'm going to be paying out, I'll show you the journal entry too, just for fun. But so I've got 10,000. So now my carrying value is 98,400. At the end of 5 years, I would have no discount left, and I would have a carrying value of $100,000. So that's going to change every year. Now, my journal entry for when I'm making my payment for interest would look like this. So, well, I don't want to. Let's do this. Let's give myself a little bit more room so it's not confusing. So when I make an interest payment, if I had my $100,000 bond at 10% with the discount. So I'm not going to write all this down with the discount of 2,000, right? So this is not a new problem. I'm just saying, what would that journal entry be for the thing we were just looking at? Okay. So I would be taking my $100,000 times 10%. That would be essentially interest expense. But I'm going to do this interest expense in a second. How much cash am I actually paying you? Well, I'm paying out. Remember, the contractual rate is my cash payment rate, isn't it? I'm going to pay you $10,000. I'm going to credit my discount. I'm amortizing this. So remember, discount. Let's do this here. Got my discount account. It started off with a $2,000 debit. And guys, this might be confusing. Okay, so just if you're with me still, then cool. If not, watch it again. If you still don't get it, it's not that big of a deal. The rest of it is more important. Okay, so just deep breath. Everybody's fine. You're okay. So I'm going to amortize this thing. I said for $400, right? Because it was 2,000 divided by 5. So this was 2,000 divided by 5. My total interest expense then is $10,400. It's the cash that I'm paying and it's the discount. So I'm going to credit. I'm crediting my discount account for $1,600. I'm sorry, back it up. I'm crediting for $400, which brings my balance to $1,600. And I'll go back to that other slide where we showed the $1,600 discount. But this would be the journal entry each year, is that I'm amortizing some of the discount. The whole thing is interest expense, and I'm amortizing the premium. Now, I mean, the discount. When I amortize a premium, it's actually going to lower my interest expense down. So just keep that in mind. We'll look at that in a bit. Okay, so looking at the this payments then in the amortization of the discount, it's an additional cost of borrowing. It's causing my interest expense to be higher. Okay, so here's that 1,600 that we just saw, right, on the discount. So this carrying value keeps working its way up until I eventually have written off the entire discount. Okay, guys, that's one little issue. Don't get hung up on that if you're confused by that. Just go back to, I think everybody understands. Let's go back to this other slide saying that, where'd it go? Where'd it go? Oh gosh, I can't see anything. Glasses, it's that one? Yeah. Okay, so do you understand this slide? So this is where most of the questions will come from, is this slide. Understanding this idea, okay? That my rate being higher than the market rate would lead to a premium. My rate being lower than the market rate would lead to a discount. Do you understand those basic ideas? That's the important part, okay? We're not done, so I need to take a break for a few minutes. I've got to do a couple things right now. So I'm going to turn this off and then I will join you back. It's going to seem like I wasn't even on at all. Okay, I'm just going to turn it back on and keep recording, but I have to turn this off right now. So I shall return shortly. All right, and just like that, we are back in business. So let's go back to PowerPoint and pick up where we left off. All right, so we stopped here, actually. Yeah. Okay. So we stopped here at premiums. So issuing a bond at a premium. So this was, we're issuing at 102. That's 102%. So if we were saying we had the $100,000 of bonds times 1.02 or 102%, that's going to give us the cash that we're receiving. So I'm getting
$102,000 of cash. My bond payable is still going to be $100,000. Okay, so I have $100,000 of bonds payable. That's what's owed to the investors. They're giving me $102,000, but I owe them, I have to pay them back $100,000. They're giving me $2,000 extra dollars up front, and that's what we call the premium. That's money that doesn't have to be paid back. I'm getting $2,000 of extra cash that does not need to pay back. So that is effectively reducing my cost of borrowing, because yes, I'm going to be paying them interest. I'm going to be paying them the 10% interest payments or whatever, which would be $50,000, but the actual cost of borrowing is lower than that. It's $48,000 because I have $2,000 extra dollars in my pocket right now that I don't need to pay back. Okay, so we said that this was an adjunct account, so it's added to, so this carrying value is up. This $2,000 premium will be amortized just like the other, just like the discount was amortized. The premium will be amortized, and what it's effectively going to do is reduce my interest cost. So I'm not going to go over this. It's in the appendix. You can look at it if you'd like to. I just don't want to confuse anybody. Where the discount amortization, if you remember, I went through that journal entry. The discount amortization actually made my interest expense higher. The premium amortization will actually make my interest expense lower, because I'm going to divide that $2,000 by 5. So $400 per year is going to be recognized as kind of a gain. It's going to reduce my interest expense. It's not going to be recorded as a gain, but it's rather going to reduce my interest expense. Remember, the bond premium is considered a reduction in the cost of borrowing. It's an adjunct account which has a normal credit balance because liabilities increase with credits. Well, if I have something that's increasing a liability, that must have a credit balance. So my total cost of borrowing then, remember, I'm still making these payments of $10,000 over 5 years, that's 50. But because I got this extra 2, my actual cost of borrowing is less than 50. I'm paying out 50,000 in interest, but my actual interest expense is less than 50 because I'm keeping that extra 2. I'm hoping that makes sense. If it doesn't, I need questions, okay? So just listen to that a couple times and just understand that this is an extra $2,000 as premium that goes in my pocket and I get to keep. So this is just kind of a repeat of the other slide, but just understand, okay, so if I have a stated rate or a contractual rate of 8%, so that's what I'm paying my investors. If the market rate or what other companies that are like me are paying is lower than that, 6%, then everybody wants my bond because I'm paying more interest. So for that reason, I can charge more money. We call that a premium. This is just review. If the market rate is 8 and my rate is 8, well, that's par value, otherwise known as face value. And 10%, if the market's 10 and mine's only 8, well, then to attract people to buy it, I have to discount the price. Okay, I'm going to come back to this. I actually want to work through these problems, but we'll come back to it. Actually, let's do it right now. Sorry, never mind. So these problems, actually, I need to show this to you because some of you might be looking at a different book. And so let's go to this here. So we're going to look at brief exercise 8 and brief exercise 9. So take a picture of that. Just push pause or whatever. Take a picture of that. I assume you could have done that by now. So I'm going to switch the screen over. Okay. So brief exercise 10.8. This one says, so all we're doing is making journal entries here. This one says that I'm issuing or selling a bond for $300,000. It's a 10-year, 8% bond, and I'm selling it at 98. Okay, so I guess what that means then is that remember the 98 means that I'm getting 98% of the face value of the bond. That's what I'm getting in cash. So my cash is going to be 294. Okay, that number comes from 300,000 times 0.98. Guys, this is a really good review question. You have something like this on your test, guaranteed. I have a bond payable of 300,000. That's what I owe. Now there's a difference of 6. And I'm going to call that a discount. So let's step back a second. I'm selling it at 98%. Why am I selling it at 98%? Well, if it's under 100, that must mean I'm not getting full value for it because my interest rate must be lower. I don't know what the market rate is, but it doesn't matter. It tells me that I'm getting 98%. I know that I'm selling this thing at a discount if it's lower than 100. Okay, so I know it's low. I know my interest rate is lower. In real life and in intermediate accounting, we get into a more complicated types of equations and stuff. When we're looking at this, we have to calculate the present value of the principal and the interest payments and stuff like that to figure out what the actual selling price will be. But here they're just giving it to us at 98, at 0.98. Okay, and just all the same things, the discounts and additional cost of borrowing. You know, I owe them 300,000, but I only got 294 up front. I have to come up with an extra $6,000. And this next one, I'm getting cash. I have bond payable. That doesn't change. Same deal. The amounts difference, 400,000. The cash I'm getting, I'm selling this thing at 101. Well, that must mean what? That means that I'm getting $404,000. Well, if that's greater than 100, that 101, that means that I am selling it at a premium. My interest rate must be higher than everybody else or than the market. So I'm getting a $4,000 premium. Again, that's extra cash I'm getting up front. I only owe them 400,000 back and the interest payments. Now keep that in mind. I am still paying the interest payments, but at the end of it, I owe them the principal amount of 400. Okay, this is a really good set of problems right here. There's guaranteed a couple of questions on the test that if you can do this problem, you should have no problem on the test. Okay, I'm gonna skip this because we don't need this for right now. One thing I'll say is if, so I have this candlestick company was one that we looked at before. We sold bonds and they were supposed to be like 5 years or something like that. But at the end of the 4th year, we decide as the company, we decide that we want to pay it off early. Now that's good to do, isn't it? If we don't have to have debt and don't have to make interest payments, if we can pay it off early, well, then shoot, let's do that. Like every time, guys, just get in that habit. If you've got debt and you've got money, pay it off. You will be much happier in the long run if you pay off debt. Well, first off, don't get into debt. But when you get into debt, pay it off as soon as possible, and you'll find your life goes much better. So if I have this $100,000 of bonds payable, we're paying it off. Okay, so I guess I am going to get into this a little bit. I'm paying it off, so I have to debit for $100,000. Now, keep in mind that my investor's not happy about this, or, you know, the reason they bought the bond was because they wanted a 5-year investment and earning that rate of interest, right? I'm now calling them up and saying, hey, I'm going to pay this thing off early. Well, they're not like super happy about that because they were expecting to get 1 more year of interest. So what I have to do then, you see this 103, I have to go to them and say, okay, look, I'm paying this off early. So because of that, I'm going to pay you a little bit of extra money to make us square, make it even. So I'm going to pay them some extra money. I've got to pay extra because I'm taking away their last year of interest, right? But I'd like to do that if it's going to save me money. Why not? Okay, so the idea of redeeming bonds or retiring bonds before maturity, the thing's not done yet, but I'm paying it off early. A couple of things that I'd like you to, ratios I'd like you to know, we already know this one, but since the current liabilities are coming up again, the current ratio equals current assets over current liabilities. Remember, it's a measure of liquidity. Liquidity is my short-term ability to stay in business. What this would mean here, this current ratio means that for every $1 of liabilities that I have $1.30 of current assets, $1.49 of current assets for every $1 of current liabilities. And that's a really important number to know. That's not the best measure of liquidity. I'll tell you, there's other ones that are much better, like the current cash debt coverage ratio and stuff that actually measures more appropriate assets than current assets, just lumped all together. Because if you think about what are in current assets, it includes our inventories, and I think we had this discussion before. But you know, inventories aren't necessarily super liquid. If we go into an economic downturn or something and we can't sell our inventory, well, it's not really a good indicator of how much liquidity we have. And so some ratios do it a little bit better, but it's a good sort of gauge as to our general liquidity. So understand this current ratio, okay, for sure. Know this debt to assets ratio. What this is telling us, the debt to assets ratio, is, you know, I have this much in assets. How much of it is financed by debt? I want to know the percentage of my assets that are financed by debt. I also just want to be able to look at this to be able to understand how my ability, I guess, to be able to make my long-term debt payments, make my interest payments, and make my principal payments. This times interest earned is more of a indicator of our ability to meet our interest payments. But this is one that I'd like you to be able to deal with and calculate. But solvency, as a reminder, is our ability to survive in the long term. Okay, last thing here, contingent liabilities. Okay, so contingent liabilities are liabilities that are arising because of something that might happen. Okay, the example that I think just kind of makes the most sense to look at is a lawsuit. I'm being sued by somebody. If I'm being sued by somebody, there's 3 possibilities. Either it's just a joke, it's a ridiculous lawsuit that has no merit and it's not going to go anywhere. Or it's possible that this lawsuit could end up with me owing some money if I'm being sued. Or it's probable. Each one of these scenarios leads me to a different necessary disclosure or recording. So when I look at this, if I have a remote possibility that I could possibly, no, I mean, that's just, I'm sorry. If it's remote, if it's like just sort of a joke where it's like, there's no chance this thing's going anywhere, I don't need to do anything with it. There's no disclosure. If it's possible, if I'm looking at a lawsuit and I'm like, well, you know what, I actually could lose this lawsuit, there's a chance. I need to disclose that in the notes. If you think about, if you're an investor, do you want to know if a company's being sued? Well, yeah, right. I want to know if they're being sued for, patent infringements or for liability issues where they got, somebody got injured by a product. I mean, a lawsuit can destroy a company. I need to know that. If it's possible, if they're looking at this thing and saying, yeah, they really need to, I need to let my investors know about this. It's possible. If it's probable, well, two things would have to happen. If I can't estimate it, if I'm just like, look, I'm probably losing this thing, but I just don't know how much it's going to be, I need to still disclose it in the notes. If I can estimate it, then I actually have to record a liability. I have to record a journal entry. I'm going to record something. The name of the account doesn't matter. A loss or an expense from a lawsuit and a lawsuit liability. I would actually have to record this in my books because it's likely that I'm losing something and I can estimate it. Think about a company like Volkswagen or something like that when they're going through the emissions lawsuits and stuff. It's a horrendous amount of money that they're going to be losing. And at some point, they got to the point where they could estimate how much that was going to be. You actually have to record that. You haven't even lost the case yet, but you're losing it, and you know about what it is, what it's going to be, what the losses are going to be, an estimate at least. You actually have to record that. Okay, and that's just full disclosure stuff, right? That's telling my investors that, hey, this is not looking good. So just so you know, if you're going to invest with me, you need to understand that I'm losing this thing. And this is how much we think we're going to lose. Okay. Okay. Come back to you here. That's it, guys. So, oh, you're there. Yeah, that's it. So things to remember here. We had notes payable. We talked about salaries, payroll stuff, looking at FICA and all the different payroll withholdings, just kind of understand what that's all about. Who pays what? We had the employee and the employer journal entries, like be able to distinguish between those to know what the employer pays as the additional payroll tax expense. They're paying FICA and unemployment. We had sales tax, be familiar with how we deal with when there's some amount of cash collected and we're not distinguishing between what the revenue was and what the sales tax was, how we figure that out. We have to divide it by 1 plus the tax rate. So we went over that. And then bonds, premiums, and discount, just kind of go through that, make sure you're good with that issue. So guys, as always, if you have questions, please email me. Just make sure you're asking questions if you're stuck on anything or lost on anything, okay? Because I want to make sure that everybody's good with all this. I know that the premium and discount thing can be a little twisty for some of you, where you just can't really kind of grasp it. So if you can think of a question, please ask it, and we'll go over more of it when I see you next time. So until then, have a good night, morning. I don't know, whatever it is for you, but have a good one. And I will see you next time.